Earlier, CNBC Africa's Gugulethu Mfuphi spoke to Sholto Dolamo, he's head of resources at Stanlib, to get an overview of the company's resources fund, and this is what he had to say.
Look, yeah, I mean, the fund started way back. It's probably one of the older funds that you'll find in the unit trust universe. It's done fairly well relative to the resources sector or the resources JSE index. We've outperformed over most periods. Like if you we like to look at long-term, kind of like measures. So whether you look at it over a 10-year period, over a 5-year period, and even on a shorter term, I think we've done relatively well. Part of the reason, I think, it's been the type of stocks that we pick in the fund. We like to pick companies that have very good management, have excellent assets, and by excellent I mean assets that will overcome most cycles, right? So assets that are fairly low on the cost curve, such that when commodity prices do come off, you still have a margin of safety relative to to companies that will have assets that are high cost, for example. So we have liked, let's say, BHP Billiton. It's been one of our core holdings in the fund, and we continue to to prefer Billiton over, say, for example, some of the gold companies, right? We think it's got excellent management. It's got very high quality assets, very well geographically split. They've got iron ore assets in Australia, they've got coal assets here in South Africa, they've got copper assets in Chile. So you get quite a nice geographic split of the assets, and they've got oil and gas assets in the US, right? So I think if you look at how it's done relative to say cost of capital, for example, right? So it's outperformed. I mean, the returns that you've had out of Billiton have outperformed, its weighted capital, underlying, the underlying what you require in as far as putting, assets to the ground.
I want us to explore BHP just a little further. It is the darling of many investors out there. They recently published a statement where they're looking to simplify their strategy. Does that change your view on them by any chance?
It doesn't, right? If anything, it enhances our view.
Wow.
So over time, as I said, BHP Billiton has been a company that operates high quality assets. So if assets begin to wane in as far as their quality is concerned, in other words, if they start to become high quality assets, say for example their nickel operations as well as their aluminium operations, right? They're becoming more and more high quality, high cost assets. So you would, to maintain a very high return out of those businesses, for example, return on capital of the group, right? You will need to share off high quality assets over time. So we think this is pretty much in line with the kind of company that we invested in for the long term.
Perhaps we might need to see a little bit more of those, but another grouping of companies that you're very popular or proved to be popular in your fund is Sasol as well as Anglo-American. Again, multinational players who have diversified assets.
So let's start with Anglo, right? I mean, a lot of people have been quite disappointed about Anglo's performance over the last, call it 18 months or so, and so have we. And I think it's begun to turn around, and the turnaround involves getting, they've got very high quality assets, and unfortunately have not operated them as well as they possibly could have, right? So if you take some of the platinum assets, for example, they've got very high quality platinum assets, very large assets as well, right? So we would expect them over time also to shed off high cost assets, in other words, to improve the quality of the platinum portfolio, right, and get the best out of that asset from a return perspective. And we expect them to do the same out of copper as well. So there's hit a bit of a speed wobble in copper over the last 18 months or so, right? But they're beginning to turn that business around. So Anglo for us remains a holding premised on the fact that it's a turnaround story, right? It's what we call a self-help story. They know exactly what they need to do to turn that business around, and we expect them to, to outperform the resources index over time.
You mentioned that you're not too bullish on gold. Why?
I mean, if you talk at a macro level, for example, right? So if we are of the view, and this is what our house view is, if we are of the view that the world will recover over time after the the global financial crisis a couple of years ago, right? That is not in an environment where gold tends to do well. Gold tends to do well in when there's huge concerns about global growth, when there's huge concerns about global inflation, right? So we do not expect inflation to run away over time, and we expect growth across the world to recover from the doldrums of that were caused by the global financial crisis. So in that kind of environment, we do not expect gold to do well as a commodity, right? Over and above that, right? our gold companies in SA, I mean, we all know, you know, the vagaries around cost and so forth, and the more deeper they, you know, they extract the gold, the higher the costs will be. So structurally, we think they are in a quite a high cost environment, right? And one that, you know, lends them to being leveraged plays. So if you believe that gold will run, right, then obviously, you know, being, you know, high cost companies, you know, they have quite a huge leverage effect, and therefore they could do well. But that's not what we believe. We believe that, you know, gold prices are not going to rally much. And given the fact that they are fighting ever increasing cost pressures from either power or from labor, you know, we don't expect them to do well, and therefore we tend to shy away from them.
Now, that's not the only sector that's going through turmoil. The platinum industry in South Africa, it's well documented that it is under pressure. But you do hold Impala as well as Anglo Platinum in your fund. Will this view change depending on how the labor landscape unfolds?
So let's unpack that a bit, right? We are of the view that incrementally there'll be more demand for platinum, right? So if you take, for example, what platinum is used for, I mean, it's used, for example, I mean, the key use is in AutoCADs, right? And that is used to, you know, to damper down global warming effects caused by emissions out of our cars, right? Now, if you're in a world where increasingly we are a lot more worried about the air that we breathe, platinum has a key role to play there, right? So we believe, although there is turmoil right now, right, we believe that over time, incrementally, there will be more demand for platinum, and therefore, you know, Impala Platinum and Anglo Platinum, you know, make it into our portfolio. But I have to put this on the table as well. We do hold the platinum ETF, right? And part of the reason is that, you know, we are bullish platinum long term, as I've just mentioned, right? However, we are, you know, wary of, you know, some of the cost inflation pressures that have come into the platinum space, and you know, and the labor pressures that have come into the space. So we prefer to have a, you know, sort of a diversified approach to our platinum bullishness view.
So quite clearly, ETFs are proving to be popular in that regard.
Yes, exactly. Yeah.
Keeping on platinum, one company that doesn't feature on this list though is Lonmin.
Yeah.
Is that deliberate?
No, it's, I mean, you know, maybe I should have explained this a bit earlier, right? So one of the key things that we use to determine, you know, which companies to hold in our funds is valuation, right? So we would look at whether or not a company is trading below or above is what we believe is intrinsic value, right? Now, companies like Anglo Platinum and Impala Platinum are, to us, trading at very attractive valuations. In other words, they're trading below, the share price right now is below where we believe intrinsic value for that company is, right? Now, a company like Lonmin, unfortunately for us, does not meet that requirement. So Lonmin to us seems to be a bit more expensive than Impala, for example, and Anglo Platinum. But it's got nothing to do with the strikes. I mean, the strikes have affected all the companies, so or most of the companies at least.
So indeed, that goes back down to the calculations as well
exactly.
as PEs there.
Yeah.
Interestingly enough, you do see a strong weighting regarding oil and gas operations, but are you seeing more opportunities across the continent, as in new companies that you might want to select to keep in your fund?
Our fund, as it is right now, invests only in SA-listed companies. We will be opening up the fund at some other point, but I mean, or we are at least intending to do that at some point. We do like the oil space, and hence the, our investment in Sasol, right? We will be looking at other opportunities within Africa and abroad, in as far as oil exposure is concerned. I mean, it's one of those commodities that I think over the long term still has very strong fundamentals, right? If you look at how much oil, for example, is consumed in China, right? Relative to how much copper is consumed in China, right? So China accounts for about just over 10% of global consumption in oil, whereas in, let's say, copper, it's about 40% of global consumption, and in iron ore, it's about over 60% of global consumption, right? So there's still a lot of growth in oil demand to come over time, and I think it's quite an interesting space to be. I mean, we all, irrespective of where you are in the world, we all want to be driving cars at some point, right? As the economy improves, right? So we expect the same to happen in China, right? And therefore we expect oil consumption to grow or at least oil demand to grow.
Indeed. So no doubt are those prospects potentially focused on African operations, Nigeria, the likes of Angola as well as Maputo coming on strongly with oil and gas operations.
Exactly. I mean, even you know, if you take, say, for example, there's been some interesting gas finds in Mozambique, right, which are probably going to be for the LNG market in, you know, into Asia. So there's an opportunity there. There's been oil finds in Kenya as well, and in the middle of Africa. I mean, there's been oil finds everywhere in Africa.
So the outlook is fairly positive on that one. Exactly. But I want to get your view on the resources space in South Africa. You've been in the game for a very long time, previously held positions at De Beers as well as Lonmin. When you view the weighting of resources, back in the day when the JSE started, it was very strong, but today that has diminished ever so slightly. Your overview of the change and the transition that's taking place? Are we moving away from mining, maybe to more oil and gas?
I think you would expect that in an economy as the economy develops, right? So mining is regarded as one of the probably the more earlier stage developmental growth of an economy, right? So as time goes on, the service economy becomes a lot stronger and consumption becomes a lot stronger, and that's basically what has happened to the JSE. So over time, as the economy has grown, so have other sectors, to a point where now we're a lot less reliant on mining. It's still very important, right? But we're a lot less reliant on mining. If you look at, GDP, if you split out, GDP contribution of different sectors, mining is a lot smaller now than it used to be. But that is to be expected, as economies grow, as the economy grows.